Hi guys, today we will discuss gold futures on the weekly chart. It's a CFD. Now I have picked 2008, the extreme volatility period. The period that helped you understand how important gold is. It really changed everything. Now, how do I start? I start right here. Before 2008, it was rising up. But then the crisis hit around March, April, and gold also declined early on. Now, why gold declined? Because basically what happens is, if I own, let's say, 100 ounce or 1000 ounce, and I own a million shares and I own a million forex pairs, and let's presume market falls off in stocks. So to cover up my losses, because basically most of the traders are trading at margin or leverage, although I don't exceed leverage beyond 15%, that is, I only buy at 110% or 115%, but no, I don't go beyond that. So you have to understand that there is a leverage involved, and for bigger players like hedge funds, they are usually trading at 130%, 140%. If you go further on, there are some traders who are trading at 200%. So 100% is their own money and 100% is leverage. So once the price falls, they have to bring in money to support their whatever bull trade or bear trade they are trading on. So to support them, they sell other things that they believe are at a higher point, because basically you can only sell good things, you cannot sell bad things. And gold is one of the best investments, so they sell that to cover their losses elsewhere, because they don't believe the price is going further down. Because if you had seen the stock market or any market, financial market, in 2008, no one was considering it to be the crash of all times. They were considering it as a normal crash, 20%, 25%. Okay, it will come back from here. So at that moment, they would have sold gold just to cover up their losses in other trades. And that's why you see gold going down. And then you see this rise up. Because eventually, when people understand that everything is going down, and it's not going down as the normal term, where do they go? Because basically, as an investor, my biggest concern is parking of the money. Now, whenever everything is going down, I will turn to cash first, or I will go to, let's say, debt instrument, because debt is also something that doesn't go that much down. And the point of it thing is, if you invest in good quality debt, then it's not that bad. But the point is that gold is also a brilliant hedging technique. If everything is going down, then gold is the golden opportunity, because as we all know, gold has its own place, and candlestick chart helps you pick that place. Now, as you can see, it's going down, and right here it's jumping up. So we'll be buying it, and it moves up and then down, and moves back up and moves higher. Now, some of you might be thinking, why the hell didn't we bought here? We would have bought it here, but there's a learning curve to it. Never try to buy on this kind of stuff where there is huge gap. It will always try to fill it up and can create losses at that time. If you're buying above that gap, that's not a good thing. Number one. Number two, double high. This was a double high. First high, second high. Number three, highs are getting reduced. This third high is even further lower. So now you need the price to go higher than this highs, so that the bull run returns in gold. Now it goes down, so that's a sell signal. You sell. So now the fourth high is even lower. This high is lower than this high. Not a good thing. Then it crosses up, so it's a buy thing right here. But the problem remains. The problem, this high. It needs to cross it to become bullish. And right here, it does cross it. So now, once it has crossed the previous high, it's bullish in 2009 January. Now in 2009 January, there was mayhem in stocks. People were like selling each and everything. Either it was a good company, bad company, or foolish company. They were selling it all. Whereas gold, as you can see, is rising above it. Why? Because people know that gold has its own place. There is a huge demand in India, in China, and around the world. So everyone was like turning their money back into gold. And that's what like drives the bull run. Because everywhere else they are bearish, so either they are turning into cash or gold. Now gold has limited supply, so you cannot park huge sums of money. That's a like remembrance thing. And always remember that. But the point is, it's still an important like hedging technique. When everyone is bearish, if you own cash and you believe that your cash will be devalued by 20%, then where will you turn to? That's gold, because gold is gold. And as you can see now, we are selling it off. But we are seeing one special thing. On this rise, it has crossed this high and this high. Only this high is left. And if I place a horizontal line on the open of this red candle, you will see it rose to the exact point. And now it's going down. So you can see that the bullish like stuff remains. And we will be buying right here. Engulfing bull candle. And the price eventually rises back up and goes down. So the point is understanding the game. Now you can see this high. Now if you remember the other lectures that we have discussed, highs form an important phase of the game. It helps you understand what is happening. And as long as it doesn't cross this high, I'm not saying gold is bullish. Now once it crossed this high, I'm not saying it's bearish. That's the difference. Now let me zoom out to show you further things. The previous like longer low was here. And then the low was here. Right? Once the price crossed up, it made a second high. On the fall, this fall, it broke this low. And then tried to make up. But like made a third high and fell off. So highs were getting lower and this middle low was broken. But the major low was here. It was lower. So the highs were getting lower and major lows were not like achieved on the low. So it was not bullish, not bearish. But as the highs are getting lower, so you are not bullish. And that brings a problem that it can someday suddenly break off and go to the lows and break those lows to form a bear market. And in 2008 crisis, everything was turning bearish. So you were not that bullish. But now if you look at it, it's like crossed those highs. So it's like away from the bearish market, but not in the bull market. You need the 1003 line to be crossed to be bearish, to be bullish. Now if you look at it right here, the price goes down and then a green candle comes up to say buy. Now, why does the price always moves in a zigzag move? Now this is an important question that many of my students ask. And the answer is simple. Now in this zigzag move, if I just move out, lows were broken, first low, second low, third low, right? And now lows are getting higher. First low, second low, third low. And now it's moving up. See? but it moves down, so you'll be selling it off, even though that candle told you to buy. And as you remember, as I always tell you, place a stop loss on the low of this candle. So on this fall, you'll be out. And if it closes lower, then you will have no problem because you are in a good point of view. Now it rises back up again and you're in a bull run. Boom. So now if you look at it further, it rises up, up, and now down. So you'll be selling it here. Right here. And then wait, wait, wait. It rises up again. Now always remember, as I told you earlier, let me zoom in to show you further. Whenever it makes a red candle and you sell, the next day it opens higher and makes a doji, then it means confusion. So it means it's not going down, but you will wait for the next day. Now next day it closed higher. This close is higher than this open. So it's like eating that red candle. Buy it. That's not a bad thing. And if you would have bought it here, then eventually you will be seeing that the price crossed that line. It made a red candle by opening lower or below this line. So it's a sell signal. But the point is that this open is always not a good thing. It should not have opened right here on the lower side. And it's a sell signal. But now the green candle is going back up again. So you'll be buying again. But the point is, risks are getting increased on this moment. The line should not act as a stoppage point. And it crosses up. And now it is a bullish pattern. 1047, be bullish. Now although it's saying sell right here and I will be selling it, but my long-term bullishness is now increased because it has crossed its previous high. Now coming below this line will make me bearish. But as of now, I am bullish. And I will be buying, and my buyings usually will be offering higher returns. Exceptionally high returns. And that's the best thing. Now always remember, on the fall, don't panic. Sell and wait for the buy signal. It will always give you a buy signal, and that buy signal will make it everything look rosy. Now if you look at it, here is a Makbusa candle, and as I always tell you, Makbusa candle is a brilliant candle. It's even more powerful than the engulfing bullish candle. But as you can see, it was powerful, but it has eventually gone down. Now this is what I call trap. People create this kind of a candle to make sure that you fell into the trap. See, it goes down for the next 2 days. But if you look at it further, zoom in, you'll see that it made a higher high. Why on earth, on a fall, a candlestick will be making a higher high? It doesn't make that sense. Why? Because this is what I call trap. They trap people so that they sell and get out. Because basically, just look at all the traders around you. They buy something, it goes down, they have a loss, they sell. Then in the next time, if you ask them questions, they will tell you that it takes double the effort to buy in again. And if it goes up, then comes down, and let's presume it's also in a loss, small loss, then on the third time they might not enter because they might not have the ability or the strongness to just go in and buy it again. And that's what the major player is starting to find. He tries to make the price go up, down, up, down, up, down, so that investor starts to go out and move into some other stock or some other futures contract, and basically leave this futures contract to that big investor, and he can make easy money. Now if you look at it, we have bought it, it moves higher, and it's again down. This is what I was trying to tell you. This is what the trap is. They know it's bullish. I told you earlier once it crossed this line that it's bullish. Now they're trying to make sure that all the major investors, that is the retail investors, panic and get out. Because basically once it crosses that high, major investor and retail investor all jump in. And now they are like stopping it up so that retail investors panic and get out. And they will panic. They will be getting out. And that's where all the major players will be accumulating gold. Because they know that that's what the game plan is. And if you look at it, it eventually goes up. It makes a big bearish candle, bad candle that I call, and an exceptionally bad candle. Now remember these two candles and keep a photocopy of it in your mind, a Xerox copy of it in your mind. You need this. Whenever you see this, that's a like extreme bearish signal. An extreme bearish signal. That's like what I call the devil's extreme candlestick. But if you look at it, it rose further high. Now always remember, whenever you see this, then do panic and get out. But wait for the next buy signal. Now this is a buy signal, you can get in. Now you might ask, why on earth, if this was extremely bearish, it didn't went lower? Now the answer lies in understanding the game. See, it went higher and now it's falling off. Because basically the person who sold it so much that he made this kind of an engulfing bearish candle will not be like a small player. He is a big player. And that's what he will be creating. Either he will be creating a box or any other problem. But he won't let it go. Now, as you can see, the price went low, went like fall, and now it's reaching up. Now, if you look at it, it made the price fell off, made it reach this low. Meaning, the person who short sold it here made the price fall so that he can get out of his like stocks or his holding. And once he's out, the price eventually rises higher. See? And this is the sell point again. So the concept of learning is understanding what is happening. And once you understand it, it's easier for you to trade. Because basically this is not a good thing. And as you can see, it was not. Eventually it rose higher, we bought it and it fell off. We had to sell it in a loss and the market came down just so that this major investor could get out. Because he is not some small investor, he is a major investor. And once he's out, the price rises higher. That's the game. That's the real game. And now you can see it's again, it like made a low. It opened lower and went down, but the next day it opened higher. But the close is 1357, this green candle, and this open is 1358, so it's lower. You would not be buying, but the next day it opens higher. Good thing. So you could have bought it on the open. Now, just to tell you, with experience, you will start to buy on the opens. But that's not something for a new guy. If you're new to Candlestick, don't just buy it on the open. But through my experience, I will know that open buying is good. Why? Because eventually it will start coming to you automatically. It's not something that I can put into your head. But what I can teach you is the safe way. Safe way is whenever it crosses up, buy. It opens lower, not a good sign, and closes lower, so it's a sell signal. Now if you look at it, this is moving towards a second double top high. Crosses up, comes down. That's the third high. And if it now crosses up, that's the fourth high. So we know on the fourth high it always rises up. So it's a bull run technique. Right here, it's a Mabuza candle, so it's like further bullish. But then it comes down. And whenever on the fourth high it comes down, then there is something definitely wrong. Now if you look at it, it's in a box. But in a box, you have to understand that it's not doing something right. On the fourth eye, it should not have come back down. And if it is coming, then there is something exceptionally wrong. And this could be the turning phase. So remember that and trade accordingly. Candlestick is so easy that it will make you so much money. But follow it to the core. Don't leave it out. If you leave it out, you will make loss in one trade, then move to some other stock, make loss in that, then move to futures contract, make loss in that, and all those losses will pile up, and that's not a good move. But if you stick to a good stock or a good financial instrument, you will always make money. That's a guarantee. It's just you need to pick what is happening on the long term and what is happening on the shorter run, and that's how you can trade easily. We will discuss the daily chart in the next chapter, and I will show you how Candlestick can transform the game on the daily level as well. Thank you.